Testing, testing, 1, 2, 3. All right. Good morning. Good morning. How are you guys doing? I thought this would be a good quote to start our day with. Making an extra $10,000 is easier than trying to save $10,000. And the sooner you understand that, the sooner your life will improve. Anybody ever heard of this guy? His name's Elon Musk. I don't know. Maybe some of you guys have heard of him. He said that. All right. What are we doing today? We are going to, here's our schedule. Here's the schedule for the day. We are going to go in and we're going to look at the futures market, and we're going to look at the indexes, and we're going to watch them start. Okay, starting opening bells here in just a few minutes. Now, of course, in the futures market, there is actually no opening bell, but since these are indexes that trade in the stock market over in New York City, and we can trade them here in Chicago, then the markets do take off and run for an opening bell time frame in these indexes. Now, we're going to watch those take off and run a little bit, and we're going to see if there's not an opportunity for us to take a trade or two. We're looking at the 1-minute chart right now. Up in the upper left-hand corner is that 15-minute S&P. Up in the upper right-hand corner is that 1-minute Dow. Bottom right-hand corner is the NASDAQ 100. And bottom left-hand corner is the Russell 2000. All right, so we're going to watch the morning bell and watch these babies take off and see how well they do. We need to go look at the news because we had some bad news. Bad news. And so is that going to cause the market to be bearish or bullish? Well, for the short term, it's been bearish. You can see there it's about 6:30 down here on the NASDAQ. The market fell, and that was because of some bad news. All right, so we got bad news. We have to go look at the news. But look at the Dow. The Dow's recovering from the bad news, and so is the Russell. Russell's getting ready to kind of rally here on the pre-market session. Market, the bell rings here in about 27 seconds. How do I know 27 seconds? Because it's 7:30 a.m. my time, 9:30 Eastern. And it is now 7:29. I can see that on my clock on my computer, and up in the upper top of the border of the chart, you can see a little countdown timer. 8, 7, 6, 5, 4, 3, 2, 1. There's the opening bell. All right, now let's see what these ponies do. All right. Usually, trying to take a position right now is a very tough situation. All right. So we don't really want to do that. We kind of want to sit on our hands for just a minute and let this thing wobble all over the place as it fills all the nighttime orders, because that's what it's doing right now. All right. The morning bell opens up, and what do? They run out and they fill all the nighttime orders that were put in by people who can't have their orders filled in the middle of the night, but they fill them on the opening bell. And so that's what's going on right now. They're just matching all those up. And as that happens, the markets kind of shoot all over the place. Sometimes it looks like a trend afterwards. It's like, well, the market just took off and went long right out of the bell. But that's usually not what happens. Usually we get lots of topping tells and bottoming tells and small bodies as the market just kind of fills all those orders and jumps all over the place. And then it calms down, and then it kind of takes back into consideration what happened in the news prior to the opening bell, and the market will start to trend in that regard. So what's our schedule again today? We're going to look at these markets open up. We're going to see if there's not an opportunity for us to take a position here a little bit, do a little day trading. That's what we like to do first thing in the morning here. But then, because we are teaching a class at the university, and I'm a university teacher, for those of you who are not aware, got new people starting all the time. I'll come in here with my little banner that tells people who I am. My name is Lan Turner. I am a former instructor at the Chicago Mercantile Exchange and the Board of Trades Education Centers, and I'm currently an instructor of finance at Utah Tech University. And so I teach trading. I teach the finance at the Tech University, Utah Tech University. And so we've been teaching a class on options trading. And so I like to come here in the morning and put on those options for our students that attended class last night. We had a great class last night. We learned all about iron butterflies and iron condors. And so we're going to go in here, and today our strategy is that we're going to go over to the stock market, and we can do it here too. That's why we have this 15-minute chart up here in the S&P. We're going to put on some iron condors and some iron butterflies. We're going to kind of work up to it. All right, we're going to start off a little bit simple, easy, and we're going to end up with a nice iron condor and an iron butterfly, and I'm going to show you the difference between those two and how to put those on and how to think about them. The most important thing is how to think about them. All right, I want you to think about what is an iron condor, what is an iron butterfly, and I want you to think about the individual legs of each one. All right, look at that Russell taking off like a rocket ship. So the Dow Dow might follow. It might jump up there and run too. We'll see. It looks like the NASDAQ wants to make a little run. These are 1 minute charts. If we like that Russell, we can just go down and concentrate just on the Russell for a minute, or we can just go down and concentrate on the Dow. So sometimes we come down here and just pull up those 4 charts. And those 4 charts are this one right here is the range bar chart. Looks like we got kind of a funny looking little start here on the range bar charts. Down here on the 5 minute chart, this is the 5 minute chart for the Dow. So these are all 4 just different time frames for the Dow. So that's what I'm looking at here. So this is a 15-minute chart on the Dow. Look at how beautiful and smooth that rally was on the Dow, just as the first market. Well, that's not. These are 15-minute charts. So that's back at 2:30 a.m. This market took off and started to run, and then slowly died down in here as we got some bad news. It's trying to turn around and go back up again, isn't it? Here on the 1 minute chart, we got kind of a rally. It looks like a little pullback and it wants to rally. Here on the range bar charts, we'll see if we can't get past those nasty little bars. We may have to clear them out. I don't want to have to do that, but we can. Clear them out? What do you mean, Lan? I saw that on my software once. How do you clear them out? Well, if you want to clear them out, you hit save on your book so it'll come back to this place. You hit new, so you get a new book or no book, and then you come in here and you go to File, drop down, you say Manage Local Cache. And sometimes what happens is between the historical data and the data that's streaming in from the internet, if you open up a chart, sometimes, not very often, but sometimes, and it happens a little bit more often on those really fast charts, but sometimes you'll have to clear out your cache. And that's just what you had saved on your computer, and they didn't match up perfectly. So they come in there and you just reboot your software, reload it. Give me 1 second. And it'll pop right back up here. And there we go. And then we just go open our chart again and see those nasty bars are all gone. That's how you clean them out. Just kind of gets sometimes your cache on some of these charts gets a little screwy. And so you just fix your cache. Has to do with your internet service provider and how fast they can connect that data. And those things can line up. And if they don't line up perfectly, from opening up the software, from your history to where the streaming data comes in, sometimes you just clear your cache and away you go. Just like brand new. All right, so that's what we're looking at here. We have the 1 minute Dow right here on the left-hand side. And while we were clearing our cache, that thing flushed, didn't it? Flushed down like a toilet. Now let's come down here and let's delete those drawing tools out of there. And this is bad news. Let's come and look at our bad news. All right. Going to bring up the news report here. And it says durable goods orders. That was at 6:30 this morning, and durable goods orders is quite significantly down. All right. So the forecast was 0.7. It was actually 1.4. So previous was 6.9, consensus 1.1. See, it says on our little chart that was down. Maybe let's read that. New orders in manufacturing durable goods in the United States rose 1.4. Oh, I thought that is bad news. Month over month in February 24, more than expectations of 1.0. That was in February. After a downwardly, that's what we're revised at 6.9 fall in January. Orders rebounded transportation. Oh, so that was actually good news. So it went from a forecast of 0.7 to 1.4. Previous was 6.9. So it actually did better. So durable goods, that was good news. U.S. durable goods orders. Oh, that's January. That's why that big drop right there is a January drop, not February. And we're in March, so we're looking at what happened last month. Durable goods orders, not counting transportation. So not counting transportation, it still was up a little bit. So it went from 0.3 to 0.5. And then the Schiller home price. This is the thing that I'm concerned about right now. Look at how home prices month over month. Did they go down? No, they went up. Forecast was 6.5. The actual 6.6. Home prices year over. Oh, that's the year over year. This is the month over month. So month over month, they went down. So month over month, they went down. Year over year, they're still up pretty nasty. CB consumer confidence. Well, that's what we're going to see at 8 o'clock. So in 20 minutes, we're going to see a consumer confidence. These are all, they're 2 impact. They're not the worst impact. We go to this one and see all the little tiny impacts. But the ones that have the biggest impact, we come down here, 3-star. Those are all red. Thursday, what's today? What is today? Is today Wednesday? No, today's Tuesday. So Tuesday, that's today, 6:30 this morning. And then Thursday We're going to have another 6:30 a.m. GDP growth rate. Oh, that will move the market. You bet your hiney it will. Forecasted to be 3.2, consensus 3.2, previous was 4.9. This is really good. So GDP growth. So if we get some good growth on GDP, well, markets should take off and go to the moon. All right. Lan, where are you getting that news? I like this little website called tradingeconomics.com/calendar, and that's where that's at. And this is the news that I like to watch. I could care less what MSNBC or CSBC or NSBC or any of those CBCs, any of those guys have to say. I don't have an ounce of care about what those guys say. That's all a bunch of worthless news. All they're doing is selling you new cars, not even used cars. They're just trying to sell you new cars and soap. And then everything they do is all, oh no, the world's falling apart. The sky is falling. The sky is falling. Come back and watch me after this message from our sponsor, Pfizer, where you can get a shot. That's what those guys do. That's why I don't pay any attention to them. I don't even watch them. I don't even listen to them. Now, that said, I do like Kramer. Kramer sends me an email every couple of days and tells me things I should be watching. And so maybe we'll pull up Kramer's email and go see what he said. He sent me a new email today and said, hey, Lan, here's some pretty good stocks you might want to be looking at. So, all right, we got the bulls and bears turned on, which is why the price bars are red, yellow, and green. We can turn those off and just go with red and green. See what's going on here. Now, what we generally like to do is we like to see these markets make a rally, a little pullback, give us a little tiny respite in the trend, and then another rally. And when it goes from yellow, get a couple little yellows in there, or reds in there, I mean. The yellows is when we got bulls and bears. If it goes green, then we'll take another position. Now, we can try and anticipate that it's going to continue this rise. There's a number of ways we can get in, but we'll just watch it right close here. Watch that little tiny chart in the upper window. We saw some strength coming out of here. We might take a long position, but it also might reverse on us. So we could come in here and drop this in. If it drops down, hits that yellow dot, we'll just take a short position. But we want to kind of go long right here. So we're going to go long. We're going to take one long just in case it wants to rally up and try and get up there and touch that blue line. Come on, baby. Now we're in. You rock and roll for me. I don't like it when it doesn't rock and roll for me. I want it to go immediately. If it doesn't go immediately, I just get right back out. So I'm going to come in here. I'm going to delete this order, put my stop up in there, just right up in there underneath that bar. Because if it breaks that bar, it's no longer making higher lows. If it's not making higher lows, then there's no reason for me to stay in, right? Higher highs and higher lows, that's an uptrend. Lower highs and lower lows, that's a downtrend. And if it's not making, well, there it goes, a wimpy little market. Does that mean you want to take a short position? Well, possibly. We can do one try. And if it doesn't go, then we stop, all right? Because that means the market slowed right down. We're going to see if it wants to take a short position at this point. We're going to come in here with our stop order. And if it doesn't go, then we don't trade anymore for a little while. We wait for another setup. But we'll take one reversal. We'll see if it wants to fall for us. But that's it. One chance. You get one chance to the long side, one chance to the short side. And if it doesn't do either one, then you just have to sit on your hands or go find something else to trade because this market stopped moving. There it goes. There's our two shots. We're got to go find something else. Don't sit here and go back and forth 100 times on one market that's not going to trend. It stopped trending. So now we have to go find something else or sit on our hands and wait for it to start to trend again. Lousy market. I hate it when that happens. So what did that put us down? Down on the morning. First thing, $90. 90 buckaroonies. That rotten little bum. It was doing so well before too, wasn't it? It was going down. It made a nice downtrend. It made a nice uptrend. And then it's just started to go wimpy sideways. That's kind of common. We kind of see that once in a while. But we gave it a shot. Now we're just going to wait and see if something else wants to move for us. It still looks like the best one in there, doesn't it? It still looks like the best one. Let's come in here and bracket the market, give ourselves some brackets for the highs, brackets for the lows. And that's what we do. We kind of bracket that opening bell where the market kind of went crazy. And then that becomes our boundary for highs and lows. And then we kind of look at that as if the market's above that channel, we consider the market bullish on the day. If it's below that channel, we consider it bearish on the day. Now, we haven't quite rebounded back up and started to rally on this Russell, so I've put in a premature lower leg here. As long as it's making lower highs, we'll keep moving that thing down. We need it to turn and start to go back up. Then we can certainly establish that low barrier. All right, it's not ready to go in there. Oh, look now, the Dow's getting ready to start to fall once again. It's getting ready to tumble out of there. We can come and look at either one of those once again. We can come down to our portfolio. We can drop down to the Russell. Mini Russell. Here's all 4 charts on the mini Russell. What's it looking like? Well, it actually looks better on the 5-minute chart and the 1-minute chart than it does on the range bar chart. That range bar chart looks real choppy, doesn't it? It's not very smooth. It was up there. We got some nice, smooth, beautiful ABC patterns. Oh my goodness. Oh my goodness. Hindsight is 2020, isn't it? Look at that beautiful drop. We got our perfect little setup. That's exactly what we're looking for. It got us 2 green bars and then boom, dropped again. And that was a big money maker right there. We break out of that little green bar to the bottom. That was $180 per contract. Each contract's a $1,000 investment. So that would have been almost $200 in there. 200 buckaroonies per contract per $1,000 investment. That would have been a good move. And then we got choppy, choppy, choppy. And that's what we generally see right on the counter trends. Choppy, 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 nice and smooth. Choppy, 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 nice and smooth. Choppy, 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 nice and smooth. It's starting to getting some choppy, choppy, choppy. I don't know if we're going to get a nice and smooth again. If we are, we're only getting like 3 bars. That's not enough to trade. We need more than 3 bars. The 1-minute chart still kind of looks like we're kind of coming down here and bottoming out, aren't we? And then we're going to go back up. Maybe back up to the magic blue line. That magic blue line is called the VWAP, volume weighted average price. It's like a magnet, like a little rubber band. It pulls the market back up there. We're breaking up. Why didn't you take a land? Why didn't you take that reversal? Well, I'm not a big fan of taking reversals because each one of these was a reversal, right? Oh, there's a reversal. Oh, there's a reversal. Oh, there's a reversal. Oh, there's a reversal. You know, reversals are hard to catch. Wait for it to reverse. Give us a little rally, then a little red, a couple little red bars, and then it gives us little red bars, and then we can take that reversal. But let's make sure it's going to reverse first before we take a reversal. Don't be in such a hurry to jump in on every little move, every little starter, every little new trend. That's if every time you try to jump in on every single new trend, that's where you get your hiney handed to you. All right, because not every single one of those little breaks up green bars is going to be a new reversal trend. Usually they're just a little pullback into the overall longer downturn trend. Now, if we get a little rally, now that's only 4 bars, 1, 2, 3, 4. That's good. And if we could get a green bar in here, then we'd take a long position. But see how that's failing? That's why we didn't go long. We need to see that thing really push higher and make sure that we're going in an uptrend before we decide we're going to start taking a long position. There, we're getting some green bars. We're getting some green bars after some little red pullbacks. Not very strong. I wish it was a little stronger. I want it to be a little stronger. Does it mean you can't take it? No, you could take it if you want to, but it's not very strong. I like stronger ones. I like strong moves. Strong. That's not strong. That's wimpy. There it goes. It's showing a little strength to the upside. Let's see if we can't get something going here on the Russell. Come on, little Russell. Give me something. Give me something. Show me. Show me. Hindsight, you'll look at that and you'll say, see, Len, you should have just taken it right from the red to green right there. You'd have been rich, rich, rich beyond your wildest dreams. There it is touching our little blue line. Let's see what happens when it touches that. See if it can hold above it. A lot of people think that little blue line is important, so it becomes important. Why is it important? Because a lot of people think it is. Yeah, see, dropped off. That's just not strong enough for us. We need strong. We need strength. Come on, buddy. Come on, give me something. Give me something. That's a wimpy market. Let's go look at something else here. If we can't get something to go here, we're going to go over and start looking at the stock market, see if we can't get something going over there using our iron condors. Our iron condors. We're getting a little bit of a break here. What's it going to do? What's it going to do? Choppy, choppy, choppy up. Maybe we get a smooth, smooth, smooth down. Wait for it to pull back just a little bit right in there. We'll try it. Okay, we're going to drop this in there. Got a flat bottom, flat top bar. Oh, choppy, choppy, choppy. 3 times. 3 strikes, you're out, Lan. All right. 3 strikes, you're out. 3 strikes, you're out. Go look at it. Oh, good thing we didn't stick around the Dow. It was even worse. Well, this morning market is just kind of sucks, doesn't it? Just kind of sucks. All right. Well, if we're going to have a negative, no rally market, let's go back to our home base and that S&P up there. Maybe what we can do is we'll put some options on that, just some neutral option strategies. What's a neutral option strategy, Lan? Well, a neutral option strategy is one that makes money when the market's dead and going sideways and not trending. Well, that kind of seems like a little bit about what we're getting right now, doesn't it? So let's come in here and we're going to go to the S&P 500. So S&P 500, we're just going to bring up all 4 charts on the mini S&P. Where is it? Can you guys see it in my list? I can't see it. There it is, 13. Lucky number 13. So if we look at the daily, let's pull up the daily chart first. And man alive, that thing is taking off, going to the moon. There was a decision point for us. We talked about that earlier. We said we can go up. We can make a 4th drive high, right? That's a D. So this is your A1 down here. This is your B1. This is your C1. That's your D1. Those are very rare. Don't get a lot of those. I got to drink some more tea. Give me 1 second. Losing my voice already. Just the day's just beginning. All right, here we go. A, B, C, D. We don't generally get very good D's, and so that's kind of coming into a little tiny pennant, isn't it? Little tiny pennant in there. So it's just kind of going sideways right now. We would expect it to break out one direction or the other. Probably not quite so bullish as bearish, but nothing says this market can't go higher. It certainly can. As I always say, just because a D is extremely rare doesn't mean it can't go to E, F, G, H, I, J, K, L, M, N, O, P, Q, R, S, T, U, V, W, X, Y, Z. Certainly can. Just doesn't do it very often. It's really super rare. So for us as small speculators, we don't like those super rare strategies because you don't want to bet on something that doesn't happen very often, right? Although this is not betting. This is not betting. This is not gambling, right? We're not betting. What was it? Somebody yesterday gave me a really good quote. I'm going to make a slide out of it. It was such a good quote. Said the gambling is betting on I can't remember the quote. I'll write it down. I'll get it. He wrote, it's in the notes over there. He wrote it in the notes and gave us a really good quote. All right, let's see. Can't remember what it was. I wish I could just remember it right off the top of my head, but you guys want to see it, it's over there in the notes on the yesterday's video. Comments. All right, what are we doing here? Oh, we're going to go up here to the 15-minute chart. We're going to put on an option strategy. Let's come on here and turn on an option strategy. We can turn these off. All right, what we got going down here? Accumulation distribution. All right, we're going to come in here, and the first thing we want to do is we want to go to our options tab. We want to take a look at what we got available to us. We got 2-day options all the way down to 35-day options. Let's look at some of these 6-day options here, see if there's any volume and open interest on them. Bring up our options chain down here. 6 days, let's just look at calls. Let's look at the traditional. We can look at both of them at the same time. So they're $1,125 a piece. And the strike price is $52.90. That's right at the money. All right. Let's go see. Let's go just look at the calls all by themselves and see what the theoretical value is. Theoretical value is 1486, and we're buying them for 1,131. That's because the markets, they're worth $1,400, but you can get them for 1,300. Let's go look at the call, the puts. They're worth 1,200, and you can buy them for 1,000. That's because the market's dead. No implied volatility, right? We talked about that in class last night. So let's come in here and let's set ourselves up with a couple of strategies. Now, the first thing I want to do is I want you to think about these things individually. I want you to think about them one at a time. I don't want you to think about them as one whole thing. It's like, let's go put on an iron condor, boom, and that's four different options. That's a tough way to do it. I want you to think about them one at a time. First thing we want to do is we want to say, well, since this market isn't rallying, right, it's probably not going to go up and break this previous high or some of these highs back in here. Maybe it'll just stay down here in this channel. So we'll just draw a channel in here. We actually have a channel tool. I'll show you kind of a cool tool. This is the RAF indicator. So we just bring that in there and it kind of draws you a channel, shows you where that market's at. Come into the preferences and we can extend that out to expiration. Actually, that's just the end of the day. Now, this is a 15-minute chart, and we're looking at, in this case, we're looking at 6-day options. So we'd really want to go out to a longer-term time frame, maybe a 4-hour, 8-hour, even a daily chart to see whether we think that 6 days is how long we want to be in an iron condor. So we might want to just do 1 or 2 days. We might just want to do, or we might even just want to do 0 days. Let's do, since we're here in the futures market, let's do a 0 DTE, 0 days till expiration condor. All right. And we'll do a condor and a butterfly just to show you the difference. So now we're going to come in here and you can see that just an iron condor is $418. Okay. So if we're going to buy one, it's $418. But that means if we're going to sell one, we're going to collect $418. But we're not going to do it right at the money. So let's come in here to our options tab and we're going to sell an option and collect some premium outside of that channel. Okay, well, about all we can collect is $60, but that's all right. We go one more click outside just to give us a little buffer. That's $32. Let's go right at it, give ourselves $60. We're going to collect $60 if we sell that option. Now, the way we get to keep that money is if the market stays below the red line by the purple line. That's all we have to do is just not rally up there. All right. If we do that, you can come down here. You can see in the bottom right-hand corner, we got this nice little calculator that tells you everything you need to know about this option. It says you're going to receive $62.50. The return on your risk is 0.51%. That's because your margin requirement is $12,000. I don't want to pay $12,000 or have a margin requirement of $12,000 just to make $62. Well, Lan, how do I stop that? How do I bring that margin down? Well, you have to spend a little of that $62.70. You have to spend a little bit of that money. You have to come in here and you have to buy an insurance policy. All right. And the insurance policy is a way of dropping that margin down from $12,300 to something a little bit more realistic. So what we do is we come in here and we buy a call and we put that out here. And see that is a insurance policy, which we're going to have to pay $27 for out of our $72. Now, what that's going to do is if the market goes up there, you start losing money at that red line, and everything between the red line and the green line is going to be loss. You're going to lose money between there. Okay, so you have a max loss there about $500. But that insurance policy you're paying $27 for at that point will stop you from losing any more money. And so then the exchange says, oh, well, if you're willing to do that, I'm not going to charge you $12,000 for a margin account, cash covered sale. I'll let you do that for $493. So now your margin goes all the way down to $493. Ooh, that's pretty cool. But you'll have to pay $27 out of your $77. It's already $77. It isn't that much money. But if you're only having to put up $493 in margin, then you can see that your return on the risk is 10%. Hey, 10% in one day, that's not bad. A lot of people will wait to get 10% on their money. They'll wait an entire year. And then they won't even do that. You go down to Cache Valley Bank down here downtown on Main Street and ask them, hey, I want to get 10% on my money. What are they going to do? They're going to say, I'm going to put you into a CD and you can have 10% on your money in 2 years. And that's a high CD. Usually CDs are what? 2 or 3%. Well, you can get a CD right now because the interest rates have risen. You can get a CD for 5%. So for 2 years, you wait for 2 years on your money, you could get a 10% return on your money from Cache Valley Bank sitting down there. Of course, a lot less likely that you're going to lose your money if it's sitting in the bank earning 10% interest. You got a little bit of a chance here that you can lose some money. What is the chance there, Lan? Well, you got a probability of being out of the money, 80%. You got a 19% in the money. That's that 20% probability statement right there that's telling you got about a 20% chance that you could lose some money doing this. Well, if I went to Vegas, what would I have? Well, if you played the roulette wheel, you have about a 50-50 chance. In fact, you even have less than that because they put those stinky little green circles down there, those stinky little green squares on the roulette wheel. And so that gives you less than 50-50%. But here you have an 18% chance of making money and an 81% chance of, or actually it's an 81% chance of being right, 19% chance of being wrong. What if I wanted to go out and even have a higher chance of being right? Well, you just take it out there farther. You just roll this out a little bit more like that. Now you have, look at that. You have a 95%. Well, it's gone up with the red one. It's 88% chance and 11% chance that you're going to lose, but you make a lot less. See that? Now you're only going to receive $30. Well, I have $512 for that. I could come in here and do 3 of them, right? If you do 3 of them, now you're making $82. Oh, we could do 5 of them. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You could do 10 of them. You could do 10 of them in there. Now you're going to make $300, which is 5.87%, and you need to have a margin amount of $5,000. The only way you would not make your money is if that market went above that red line. Hit the purple line above the red line. That's the name of the game that you're playing right here. Hit the purple line above the red line. That's why you want to do this over the top of your charts. A lot of software programs don't lay it over the top of your chart, so you can't see where your orders are in relationship to the underlying stock. It's the whole idea of the name of the game. You got to see how those options are in relationship to the underlying stock. I don't know how the hell people can trade options if they don't know where the hell they are on the screen, where they are on the chart. You got to have a little marker that shows you on the chart where they're at. You can move them up and down just like that. That's called drag and drop order placement. That's why Track and Trade is one of the most amazing software programs in the world. Man, what are you talking about? Let me show you. I know some of you are wondering what the heck I'm talking about. Let me see if I can find it for you. Track and Trade. Stocks and Commodities Annual Reader's Choice Award-winning platform. Annual Readers 6 times. Actually, it's 7 times. I've got to upgrade. I keep saying that every time, but you know what? It gives me the opportunity to tell you that, hey, it's actually 7 times, not 6 times. That's 7 years this software has won Annual Reader's Choice Award. That's because people love it. All right. So if you don't have this software, go get it. It's easy to get. You just go download it and install it. It's called trackandtrade.com. Trackandtrade.com. Go get your real software platform where you can actually do some real trading over here. All right. So this is a real trading platform, not one of those cheap little online website programs. You can't trade with those. Nobody trades with those. All right. So here we go. That is a wonderful little strategy right there. You could do 10 of them, but you're like, man, Lan, that's $5,000 in margin. I don't want to do 10 of them. Well, don't do 10 of them then. Do whatever you want. You can come back down here and just do 3 of them if you want. All right. You come in here and adjust your quantities, whatever you feel comfortable with. You're going to receive $100. That's a 6.84% return on your money in 1 day. And all the market has to do is stay below that red line. Okay. Stay inside that channel that it's created over the last few days. When was the last time it broke out of that channel? It was clear back here. And then before that, let's see, there's that channel. It's actually in kind of a downtrend channel, isn't it? But let's not be too optimistic about a downtrend. Let's go ahead and go, well, how far back is that? That's back on 321. Today's 326. That's 5 days ago. So over the 5-day period, that's what that market's done. So it's kind of rallied up. And it's come up, and could it break above and go up and break above that? It certainly could. In fact, the odds of that happening are 13%. You have a 13% chance that it's going to be above that red line. That's what those numbers down there tell you. Are you willing to take a 13% chance against that to see if you're going to make $300? Or in this case, $100, because we backed it off to quantity 3. You're going to put up a $1,534 margin. You have to have $1,534 in your account. And if that market goes up there, they're going to margin you at max loss. So if it went up there and hit that green line, if it went up here and took off and went all the way up there, you're going to lose about $1,500. All right. But the chances of that happening are 6%. You got a 95% chance that that's not going to happen. Right. If you believe the numbers, if you believe the odds, but that's the odds. Now, that's a kind of a neat little strategy right there. All right. That's called a vertical spread. A vertical spread? You were tricking me there. You weren't telling me that it was a vertical spread. You were just doing it. I know. I didn't want you to worry about the name of what these things are. I want you to think about what's going to happen. You're going to sell this one and collect $135. You're going to buy yourself a little insurance policy up there so it doesn't lose all that $15,000 max profit loss potential. And you're going to cap it with a little bit of insurance. And you're going to pay $52.50 for that insurance policy. All right. And in that process, you've created what we call a vertical spread. Why is it a vertical spread, Leonard? Well, because it's vertical. One's on top of the other and on the exact same dates and the exact same times and the exact same expiration dates. Okay, so that's called a vertical spread. Wow, that's pretty cool. And so all the market has to do is just not go above that red line and I get to make $105. That's right. I could do 10 of those. I could do one of those every single day. Well, not exactly, because you have to have a 0 DTE to expiration. We usually get a 0 DTE to expiration every day. So yeah, you could probably do one of these every day, make $100 every day. And if you really get good at it and you're confident and you're good at your analysis, why not do 10 of them? Why not come in here and run that thing up to 10? You know, and maybe you don't do 10 every day, but when you have real good confidence that that market's doing what you want it to do, you could put it up to 10 and make $300 in one day. But let me show you something else that's really cool. You could come down here because this market probably going to stay in that channel, right? We know that it's got roughly an 86% chance staying inside that big long channel, just kind of wandering right through here. Maybe come up here, maybe come down here and just kind of stay inside that channel. Why don't we put one down here too? We could put one on the other side. Watch this. We can come down here. We can sell a put down here. That one up there, we sold a call. So on the underneath side, we'd want to sell a put. Now, if it's on the outside of that channel, we're only going to make $27. That's not very good. Why? Because, well, it's up there pretty close to the top of that channel. So that means it's quite a ways away. So we can take a line. We're going to draw a line from some of these low points in here. And that would be if it came down and broke this low. If it came down and broke this low, we'd be in here. If it came down and broke this low, we'd be down here. What's the chances of that happening? Well, you can always look down here at the probability table and it'll tell you, but we have to go look at the calls. Let's come over here. Actually, I'm going to look at both of them at the same time. This is pretty fancy software, so I can do that. I just come down here and I hit out of the money, OTM, and it's going to show me the calls on top and the puts on the bottom. That's just exactly what we're looking at up there on the chart, isn't it? We got the calls on top and we got the puts on the bottom, so we can see our options chain with the calls on top and the puts on the bottom. How about that? So there's our orders up there on top. You can see I'm outlined in green and red. If you want to move them down here, you can. You can just grab one and move it down here. Moves it up on the chart, or you can grab it and move it down here. Brings it back down. That's a pretty neat tool right there. And then we're going to come down here and we're putting one down here. You can see that we got a 94% chance that that thing's going to pay off. Well, but it's only $25. And we have to buy some insurance because if you notice, we've gone back to our margin requirement of $12,327. But we know we don't want to do that. But we don't need to have just a 94% chance. We can come all the way up here. Let's try 80% chance. Now that puts it inside that box in there. And we already decide we don't like it up inside those red lines. Let's bring it down one more click right there. That would be, it would have to come down and break that new low and break down and continue down below that new low. But that would be an 87% chance that it's not going to do that. All right. 11% chance it's going to do that. 88% chance it's not going to do that. Come down and be below that red line by expiration. But if we're still a little worried, we could bring it down one more click, and that's only $37 again. Outside of that entire channel, that's $25. Just almost not enough money to do it. So we have to bring it a little closer to make it worth it. All right. So that's $62. We're going to kind of pinch it a little tight in there. It's going to have to stay inside of that box. But we got basically an 87% chance it's going to stay inside that box and stay above that red line. So do we like those odds? Well, let's go in and drop in our insurance policy. We're going to come in here and we're going to buy a put. We have to buy a put because that's how you make money if the market falls. So we drop that in there. If we put it right close, ooh, that's the $42 insurance policy. We drop it down one more. That's a $30 insurance policy. We drop it down one more. That's a $22 insurance policy. How much do you think you're going to need that insurance policy? If you don't think you need it, you can get a less expensive insurance policy. You can put it clear down here. But if you think you might need it, you might want to pay a little bit more for it. It's kind of like driving your pickup truck. Are you a very good driver? If you're a really good driver and you drive around with a lot of people who are really good drivers, Yeah, they got to have insurance on their car. So it's really all about you, isn't it? So are you a really good driver? Then you don't have to have very good insurance. But if you're not a very good driver, you better have some very good insurance. So it's kind of the same here in the financial markets. Are you really good at predicting market directions? If you are, you don't have to have very good insurance. But if you're not very good at predicting market direction, then you better have some pretty damn good insurance in there because you're probably not very good at picking market direction. So you want a little better insurance. So you kind of have a happy medium in there. You don't want to be overinsured, but you also don't want to be underinsured. And so you want to make it worthwhile. So you have to come down here and you drop that in there. You see that drops your margin all the way down to $5,000. Well, we got 10 on one side and 1 on the other side. And you can come in here and you can run that up to 10 if you wanted to, 7, 8, 9, 10. Let's just for fun see what that would be. We put that up to 10. Now, if it stayed between, let's get rid of these red lines so we don't have so many red lines on the screen, Lane. You got a lot of red lines in there. Let's get rid of some of these arrows too. All right, so here's the name of the game that we're playing right now. If we think this market's going to stay inside that box right there, we would make $700. All right, if we think it's just going to stay inside that box today. But if we think for one reason or another it's going to leave that box, well, we probably wouldn't want to do it, especially if we thought it was going to go up. We just get rid of one side of this. We could just kill it and then not have that upper box. If we thought that thing was going to rally and go up there, then of course, we wouldn't want to put that one up there. All right. So I call that a chicken wing. Why is it a chicken wing, Land? Because I'm chicken, too afraid to put on both sides because I'm afraid the market might go one direction or the other. So I just put on a vertical spread to either the downside because I think the market's going to go up, or I'll put a vertical spread to the upside if I think the market's going to go down. So that's how I would do what I call a chicken wing. And they're just vertical spreads. That's all they are. But I like to name things funny names because it's a lot more fun. Makes you guys laugh a little bit. So then we come in here and we're going to put on 2 chicken wings. So then they're not really chicken wings, are they? What would they be if they weren't chicken wings? Well, that would be an iron condor right there. That would be an iron condor, and he's not very chicken. He's got big muscles, that iron condor. All right. So there's a big iron condor on there. No chicken wings here. If we took one of his wings off, that would be a chicken wing because we're afraid to put that wing on there because we think that market might either go down here or it might go up there. And we're going to get rid of one of the wings, the one that would be the one that would lose money. And we just keep the one that's going to make money. All right. But if you really do think that market's just going to be dead and go sideways, well, heck, just put on all 4 of these. All right, just put on all 4 of them. Now I'm going to show you a little trick. The way you do that is you can come in here and your spread's $100 on this thing, but when you got 10 options, that's not so bad. If you want to come down and be a little bit more cautious, we're going to be, since this is a beginner class, we're just going to do 1, 1, 1, 1, 1, 1, 1, 1, 1, 1. All right, rather than 10. So we're going to receive $72.50, and we're going to risk $500. But that's our max loss. Well, $500 is not going to be max loss because we're not going to lose on both of them because we can only lose on one of them. Because if the market comes down here, we win on that one. And if it comes up there, we win on this one. We lose on that one. So $575 is just the margin amount you have in there. But if it stays inside that box, you're going to make 12% return on your money in one day. That's pretty damn good. Go down to Cash Valley Bank and ask them if you can make 12% on your money in one day and give you an 86% chance that that's going to happen. Well, they're going to tell you to go pound sand, right? So that's why we like to do these. Now, can it be a little bit more cautious? You can pull them out there so you're not making quite 12% and you have yourself a bigger buffer, but that's kind of where we're at. So we're going to come in here and we're going to put this on, but I'm going to show you a little trick. Well, let's go put it on. What we do is we come in here and you could bid for it and see if you can't get that spread down just a little bit. You come down here. The midpoint is 190. And actually it's changed since we put these on. So the 190 on here, we're actually 95, 16%, 575 on the margin. We go ahead and say, now it's moved to 80, 750. Let's place our order. Are they going to let us have it? Probably not. Because we're in the demo account, right? This is not real money. We're just learning here today. We'll go put this on in real money tomorrow, all right? After we learn a little bit about how to do it. Watch it, see what it does, how things happen. That's why you come and put them on in a demo account first so you can learn, and then you go and say, well, I've done 50 of these and I made money on 49 of them. I think I'll go do that now in the real money account. I'm getting pretty damn good at this. So that's how you do it, and that's how you learn, all right? So now we're going to come in here. We're just going to mark it into this thing. So we mark it into it. There we go. We got our position. We sent that off to the exchange. They looked at it as all four options simultaneously at the same time. And they said, hey, that's pretty cool. I think we'll fill all four of those because he put that on there as non-iron condor. And I'm certain that he doesn't want me just to fill one or two of those. He wants all four of them filled at the same time, or else he doesn't want to do it. And so what that does is that makes it so that they fill all four at the same time, or they won't fill any of them. All right. If they can't fill all four of them, they won't fill any of them. That's why you send them all in on one ticket at the same time. But now the problem is they're tied together. If we come in here to the positions, you can see that they're all tied together as one item. And they tell you, hey, combined, all four of those options combined, you're down $2.50, which is good because our spread was what, $10, which means we've already made, well, now it's $5. We've already made $5 or $7.50 in here. Market's already started to move in our favor just a little bit. What do you mean it's moving in your favor? Well, it's just got to stay inside that box, right? If it stays inside that box, then time decay, or what we call theta, is going to decay over the rest of the day, and those options will become worthless. And as they become worthless, that money goes into your account. All right. Now, if you liquidate the thing right now, well, you have to give it all back. Plus, you'd have to lose $7.50. You'd have to give them back some of it. But if you just let it sit there all day, now you don't have to really do anything. You just let it go. But what if the market really starts to roll, Land? What if it starts to go up there and I get scared? What do I do? Well, there's several things you can do. Of course, you can take that one off, right? You can take that one off, just get rid of it and take a little bit of a loss against your profitable one that's down here, right? Because this one's going to be making money if that one's losing money. Now, they'll kind of fluctuate throughout the day because the market's going to rally a little and then it'll pull back, and then it'll rally and it'll pull back. And as that happens, these options will go up and down in value. But the whole idea, as long as all it has to do is touch that purple line before it goes outside the red line, or the red line to the top or the red line to the bottom. But what if it does go outside the top or the bottom line? Well, you can do what we call roll. All right. And this is why I'm going to show you another little trick. Sometimes what I like to do is I like to run these things autonomously. Autonomously, that's a big word right there. That means that you just run them all by themselves. All right, you don't hook them together like we did this one. This one here, we hooked them all four together. So what I do is I'm going to come in here and I'm going to take that thing and I'm going to liquidate that entire thing. We're going to come in here and liquidate the multi-leg, and I'm just coming in here. We're going to mark it out of that, and boom, it's gone. That's how you get out of it if you don't want it. All right. So now we're going to come in here, we're going to put it back on again, and we're going to do the exact same thing. We're going to come in here, we're going to sell our call right there outside the box, and we're going to buy our call outside the box once again, just like that. Now what I'm going to do, see how that top leg is up there all by itself? I haven't put the bottom leg in yet, although I could, but I'm not going to. I'm going to run this autonomously. All right, so we're going to come in here, we're going to market order into that, hit place order. Now I have just a vertical spread on the upside. That's the one I call the chicken wing, right? Because we don't have the lower wing. But now I'm going to go put that lower wing on. So let's go ahead and do that. We're going to come in here and we're going to buy a put right down there, just like that. Actually, we want to sell our put first. Let's come in here, sell our put. We're going to put the sell put right there where we had it before. We're going to put the buy put right where we had it before. Just exactly the same thing we had before. The difference is that I'm going to come in here now. I'm going to put that one on autonomously. So now I don't have a iron condor. I have two chicken wings, but two chicken wings makes an iron condor. So it's the same damn thing. We didn't change a thing. They're just not hooked together anymore. Now you see them independently down here. See here, down here in your window that says positions. Now it shows the two up on the top side because they're hooked together. See a little white line between them. That means they're autonomous. That means they're one and the same. That means they're hooked together. That means we're calculating profits and losses based on the two added together. See that? That's what that's telling you over there. And then down here, we've got the same thing. So we got one on the bottom side, one on the top side. Two chicken wings makes an iron condor. So it's the same damn thing. The only thing that we've done differently is we broke them apart and we're not put them all on the same ticket so we can manage them differently. So now as we come in here, watch this neat little trick. The reason I do that sometimes is because sometimes this market actually does take off and run up and go up above my red line. If it goes up above my red line, now I could just wait because good chance it could just come right back down off my red line. But if I'm worried about it, I can do something called roll. I can roll my options. Now there's a couple of ways you can do that. You can do that the fancy way by just right clicking on it and saying roll my options. I want to roll up. I'm just going to roll it up to 53.25. You just roll it up one like that. There you go. It just rolls it up. So what it does is it sells this one and buys that one all on the same ticket. We're going to hit cancel on that. I'm going to show you. You can just roll it manually. You can just come in here, and it's the exact same thing. We bought a call, we sold a call, so we're going to roll it. So all we have to do is we just come in here and we sell one just like that, and you buy one just like that. And usually when we roll it, we do it on the same ticket. So that's what makes it really cool. So it sells one and buys one. That's called rolling. Or you can do it manually like this if you want to. And what it's going to do is it's going to roll those out. But you wouldn't want to do it now, because if you rolled it out right now, you're going to go out there and you're not going to make any money. You're going to receive $15 and $10, and that's not worth rolling. So we don't want to roll them. All right. But you can do that all at once. You just come in here, right click, and say, I'm going to roll the multi-leg, and I'm going to roll it up. I'm just going to roll it out one more. I'm going to roll it up one strike. All right. So roll it one strike, just like that. Let's go ahead and do it just as an example. So you can see on your marker on your screen, it just put them out. All it's going to do is it's going to sell the ones you got, and it's going to buy the ones a little bit further out. And so that's going to move that red line up a little bit. It's going to cost you a little bit of money. Yes, it is. But it's going to keep you from having a loss. All right. So you're going to roll that thing out. And if it keeps going, you could roll it again. You could roll it again. You know what else you could do is you could roll it and add one. So then you could come in here and say, I'm going to roll it out. Start with one. If you roll it, you take your one off and put on two a little bit further out. Then you make more money covering the losses that you had to incur from rolling. And then if the market drops back down, stays inside your little box, which you just made your box bigger. That's really all you did. Make that box a little taller. And then you make money that way. That's called rolling your options. All right. And that's why I kind of like to break those apart sometimes, because then I can roll just the two at a time without having to worry about what's going on down here on the other leg of that. So that's called rolling. Okay. That's a really cool little tool in there. Makes it really easy for you to do it. Makes it really understandable. So we could do the same thing down here. We can come down here and we can say, I'm going to roll my multi-leg. I'm going to roll it down, and I'm going to roll it down one strike, just like that. And we'll do the same thing. You just go ahead and hit market order, execute that. You could bid for it if you want to try and save a little bit on the spread, but that's going to delete these, or it's going to remove those and just roll you down one, extend the box a little bit, costs you a little bit to do, which is why you might want to increase the quantity over here on the second one on the first roll. So you make a little bit more money to cover the loss of what it cost you to roll. And so that's it. That's cool, right? Let's go ahead and cancel that. We're not going to roll that one. Now we're going to come in here, and I want to show you, and this is an iron condor. This is an iron condor. All right. Let's show you an iron butterfly. Oh no, Land. This iron condor is breaking my brain already. Iron butterfly's got to be really hard, isn't it? No. Iron butterflies are just as easy as iron condors. They're in fact the same thing. They just got one little twist to them. Just one little twist. All right. What is that little twist, Land? Well, that little twist is what makes the difference between an iron condor and an iron butterfly. The fact is, the iron butterfly, all we do is we take the sold options in here, the sold call and the sold put, and rather than have this big gap between them, this big gap in here, a $2,000 gap between them, all we do is we put them right on top of each other. Put them right on top of each other. Watch this. I'm going to come in here and I'm going to show you how easy they are. I'm going to come in here and liquidate the multi-leg. Let's get rid of that baby. Take that off. And we're going to liquidate this baby. Liquidate. Take that off. Now let's put them back on again. We're going to come in here, and this time we're going to put on an iron butterfly. All right, an iron butterfly. So we do the exact same thing. We're going to sell a call, put it in here. We're going to sell a put in here. Oh, wait, that's an iron condor. Let's make it a butterfly. We just bring it right up here to at the money. Bring it right down here to at the money. Oh, my goodness. What is that? That is a short straddle. But we need to put the wings on it to protect ourselves, because it's short, meaning we're going to have $12,000 in margin requirement, but we're going to receive $645 or 5% against our $12,000. But let's put on some insurance just in case this thing goes to the moon or falls out the bottom. All right. So then we're going to go and put our insurance policy on there once again. Going to come in here. We're going to buy a call, and we're going to put it out there a couple clicks, 2 or 3. How far do we want to have that thing go? We can come out here. We'll go 3 clicks away. 1, 2, 3. There you go. And we're going to come in here and we're going to buy a put too. We're going to come in here and we're going to buy a put. 3 clicks away. 1, 2, 3. What do you mean 3 clicks, Land? 3 clicks. 3 strike prices. Okay. See that? 1, 2, 3. 1, 2, 3. 1, 2, 3. Oh, we're 4 on that one. Let's bring it in one just like that. Oh, that's pretty cool. You just did it right down there in the options chain. Yep, I just grabbed it in the options chain and put it where I wanted it. Now you've got 80% chance out there and 84 or 30% chance. So you got basically a 20% chance that this is going to not make money for you. That's pretty good odds, 80-20, right? If you want a little higher, you could put that one up there a little bit more, but you're going to watch your margins going to go up if you do that. You're going to have a little bit more margin. So we're going to move those insurance policies out like that. Okay, so now we're at a margin requirement of 320. Return on risk is 175%. What the heck? And we're going to receive $560 on that iron butterfly. All right. So that's the name of the game on an iron butterfly. You got the receive bigger money, receive 352 and receive 277. So you got a bigger money on that thing. That's why the iron butterfly has a little bit higher risk, but not too much. You got your insurance policies out there to protect yourself. You can bring those in just a little bit closer if you want to have a little bit better insurance policy if you think that thing's going to move. But, that's where it's going to stop making money for you. So if you bring those in, it's going to cost you more and you're going to make less. All right. So you stretch those out. You're going to receive more. If you put your insurance policies out, you're not going to pay as much insurance. And you got where the market can make you more money. You're just not paying more insurance, but you got a bigger loss potential. Margin requirements 320. They're going to margin you at your max loss of 320, and you're going to receive 536 or $167 on your position. So you're going to receive 352 and 392. You're going to pay insurance of 47.50 and 45. There's your iron butterfly. It's the exact same thing as an iron condor. It's just that we put those options right on top of each other. All right, so it's a little bit more aggressive stance, a little bit more aggressive. That's why you're going to make so much more money doing it. All right. So let's see. That is an iron butterfly. Which one should we leave on? Should we leave the iron butterfly on or the iron condor? Let's go ahead and leave the iron butterfly on. Right. So we're going to go ahead and we're going to place that order. All we have to do is send it into the market. Now we could do those individually because we might need to roll one, right? We might need to roll one. So you could put them on individually. Doesn't mean you can't roll them. If you put them on at the same time, you certainly can. You can go in and do the roll without having to do both of them, but it's easier if you just do them separate. So that's why I like to do them separate. All right. You just have to manually roll them if you're going to roll them. If you've got all four of them on one ticket, you have to manually roll them. You can't just automatically roll them. Let's try it. Let's see. Liquidate, multi-liquidate, roll up, roll up. Yeah, see, it's going to make you do them individually. Liquidate the multi-leg, liquidate the option, roll the option. We can retrade. We can retrade the multi-leg if we want to. Oh, I think that's really doing well. I want to buy another one just like it. You could do that. But you can't roll it, okay, because it's going to roll all four of them, and you don't want to roll all four of them. You just want to roll two of them. So that's the name of that game. All right, so there we go. There's an iron condor and an iron butterfly on the 15-minute chart on the S&P 500. Showed you how to do that. We're going to jump over and we're going to go take a look at, I think we got just a couple minutes left. We can go look and see what Kramer's doing over in the stock market. For now, we're just going to come back here. And we're going to go back and look at the mini indexes. And we can come and put all four of those back up on the chart. And there, up there in that upper left-hand corner, we can kind of keep our eye on that little iron butterfly we got going right there. And if you want to, it doesn't have to go all the way to the end to make all your money. That's just your max profit. It stays inside that box all the way to the end, you make your max profit. You can come in here and right-click on it and say, liquidate the multi-leg. And come down here and tell it, hey, if I just make $100, I'm going to be happy with that. And you can say, you can run this thing up here and say, oh, let's go the other way. And say right there, pay me out when it makes $100. So you can just come down here and run this all the way down to see where it's saying payout 472. We're going to bring it all the way down. What do we have to be? We're going to bring it down. Let's bring it down a little faster. So did I bring too far? No, that's good. We bring it all the way down. Let's say $200. So there we go. So it says pay me out at $200. I'm going to hit place order. That way it's going to limit order on there that says, hey, if it hits $200 in profit, Lance's happy with that. He doesn't need his full $500. He's just going to take it off at $200 and bam, it'll take it off right as soon as I make $200 on that thing and away we go. All right. And we can come in here. Now we got the Dow up here. We can do a little day trading. Good thing we haven't been trying to day trade today because this market's just been really shiny. Was that a swear word? Am I going to have to go confess? Shiny. Is shiny a swear word? I don't think so. All right. There's the Russell 2000. Russell 2000, it's trying to trend a little bit here, but it's been dead too. NASDAQ's dead. Everything's dead. Well, that's good for our iron butterfly over here. Let's go look at the stock market. Right. Hold on one second and I'll yank that up out of here. Come on, Windows. Speed her up. All right, there we go. Let's go in and pull up I'm going to pull up Kramer versus Kramer. Let's see if I can find my Kramer. I had it here just a second ago. All right, what's Kramer say? Jim Kramer. We like old Jim Kramer. We're going to come in here and read a Jim Kramer story. All right, my top 10 things to watch today. He says U.S. stock markets were higher Tuesday morning as investors look to resume the month-long rally after a down session. Headed into the final days of March, all three major averages are on pace for a fifth straight winning month. Economic reports to watch Tuesday: March consumer confidence, durable goods, and the S&P Schiller home price data. We did that. We went and looked at that news already. So we did that, Kramer. So we're on track with you here. So, hey, wait a second. Are you guys able to see this? I kind of screw things up with this. I don't know if you guys can see that. I'm not very good at this YouTube thing yet. I'm still learning. Still learning. All right. I just want to make sure you can see it. Okay. Yeah, it seems you can see it. All right. All right, let's come in here and finish this off. Let's come in here. Bank of America added music streamer Spotify to its U.S. #1 list. A collection of research firms' best ideas, and removed Netflix, which has been a home run. Bank of America added music streamer Spotify to its U.S. one list, a collection of research firms, and removed Netflix. Well, let's go look at those two stocks then. Okay, we're going to create a new one here, and we're going to say, this is Kramer. I think we got number 3 in here. Kramer, number 3. I think we got 2 other Kramers in here, don't we? Jim Kramer picks 1, 2, 3. Oh, this is Kramer 4. Jim Kramer picks number 4. Jim Kramer picks 4. All right, so he's saying Spotify. Do you guys know the symbol for Spotify? I do not. SPOT. That's a pretty obvious one. Oh, they like that. Buy high, sell higher. That is a buy high, sell higher strategy right there. What do you guys see on that? I'm not real fond of that right there. Not real fond of that position right there. There is trying to break above a previous high and it failed. We're on the back side of the MACD. Kramer, I want to see that thing pull back a little bit before we jump on. Not that it won't. It could certainly take off and go to the moon. But technically speaking, it should come back down here first. If you look back here, you say, but it did the same thing here, Lan. It came up. Oh, yeah, but look at where it pulled off. Okay, up, hit that high, pulled back. Didn't quite make it to 38.2 on that one. I had some pretty big drops there, but this is giving a big recommendation that we should get into this thing right here. Bank of America says, buy, buy, buy. A lot of these guys like to buy high and sell higher. I like to buy low and sell high. I don't know. What do you want to do with that? You guys want to take a long position off of that thing? Let's do a little count and measure. Let's turn on the bulls and bears so we can see what turn off the ATR. We don't need that. I don't know. This is obviously a nice big drive right here. I'm going to call that drive 1, drive 2. So if that's drive 1, we're going to call that A1 right there. That's going to be B1. That's coming into C1. So it's going into a C1. All right. C1. I don't expect it to be as big as the B drive. That B drive is pretty darn big. What do you want to do, Lan? Well, I think I'm going to come in here and buy myself a vertical spread. How about we do that? Since we just learned what they are. What would you do with a vertical spread in here? Well, let's come in here and let's go out 24 days. We could sell a call. We could sell a call below the market, and we could buy a put. Not call. What am I talking about? Cancel that. We're going to come in here and we're going to sell a put right here below the market. Collect $219, buy a put down here. And where do you want to buy that put at, Lan? Well, I'm thinking maybe I could buy that put right down here underneath that Fibonacci ruler. I'm not going to count the current bar because that's the one we're working with. If it comes down and breaks that low, we think it's just going to stay above that red line. That's the name of the game. It's got to go all the way to there. And then how much would we make? We'd make $67. Are you willing to risk $67? Are you willing to risk that? You got to have a $500 margin, 67. Why don't you just buy a call, Lan? Everybody thinks it's going to go up. Kramer thinks it's going to go up. You could just buy a call. Or you could sell this, and then if the market comes down, you'd get exercised on your green, on your buy put, right? And then you'd own the shares at that level. You could do that. You're going to buy the insurance policy. Let's just cancel that. What if we just sold a put? Sell a put down here. Collect $100. Do we have enough money in there to do that? We need $23,000 to put that on. We have $69,000. But we could come in here and buy some insurance. We could buy a put down here and put on a chicken wing. We could put on a chicken wing. We'd make $23. Let's move that down a little farther. Make $52. A little farther. We make $66. Put that up there a little closer. 225, 162. Now we'd have to stay above that red line or we'd start losing money. We'd lose all of our money, $225. Our max loss would be $1,500. Scoot that in there now. Our max loss would be $1,000. Do we want to do that? Risk $1,000 to make $120? Well, what's your odds, Lan? Your odds are that you're going to be, these are puts. Your odds are going to be 33%. Ooh. No, that's implied volatility. Probability of being out of the money is 84%. You'd have an 84% chance of collecting $120 on that trade. All it has to do is just stay above that red line. It comes down below that red line, you're going to lose everything, up to $1,000. That means it'd have to go below the green line to lose $1,000. Do you want to do that? That's just a chicken wing. It's one side of an iron butterfly, or an iron condor in this case. If we do an iron butterfly, it'd be right here. We put it right on top of it, right? That'd be your iron butterfly. Now you're going to receive $751, but it's got to stay above your red line. And your max loss at that point would be $3,000. So you bring this up a little bit. Now your max loss would be $1,250, and you make $465 as long as it stays above that red line. What would happen if you just bought a call? If we just come in here and bought a call at the money, it'd be $935. So this one actually has a little bit bigger risk than a long call. You could lose $1,250. Let's click it up one more. 1,000. There you go. $750. Now you're going to receive $305. And all it has to do is stay above that red line. As long as it stays above that red line, it doesn't even have to go very far. It just has to stay above that red line. It has to hit the purple line before it hits the red line. And the maximum amount of money you would lose is $750. Maximum amount of money you can make is $305. And the probabilities of that's going to happen, these are puts. You got a 50-50 chance. Of course you got a 50-50 chance. It's right there at the money. So that's one way of doing a synthetic long position is what we call that. That's a synthetic long, but you only have a long to 305. Okay. Synthetic only because you got $750 to the downside. But if you were to buy a put, you'd lose $812. But if you bought a call, call would be $1,000. And you could lose $1,000 on a call if it went below the red line. Of course, it's got to go above by $1,000 to pay for the premium of the option, right? So it's got to go kind of explosive. This way, it doesn't have to go explosive. It just has to stay above the red line. You're going to make $300. But you have max profit. Your max amount of money you can make is $305, and your max loss is $750. Well, I don't like that. The max amount of money I can make is less than the amount of money I could lose. Yeah, well, that's a vertical spread. So we're going to come in here and we'll hit cancel on that one. And what if you just came in here and bought the call? We're going to buy the call. So we come in here and we say, Well, where is that, the money? Center that baby right there, $1,000. So we're going to buy a call. Same thing. We got 24 days till expiration, and it's going to cost you $1,000. Well, what's your max loss? Well, $1,000. What's your max profit? Unlimited profit. The thing can go to the moon. You can make all the money in as it wants to do. But by the time it hits that purple line, it's got to be above $1,000 because it's got to pay for itself. So the market's got to move 1,000. How much? 1,000. Oh, it's 1,067. So let's put that at 1,067. Right, and that's about as close as I can get it right there. So it's got to be above that line right there at expiration, or else you lose $1,000. There's a chance you can make a nickel or two in there and in between if that market wanted to go, but it's got to be above there at 24 days. That's 24 days. I don't know if it's going to be above there in 24 days, Lan. How much are you going to lose per day? Premium per day loss is going to be $44. So the market's got to move at least $44 a day just to break even. It's got to stay above that blue line I drew in there. It's got to stay above that blue line. Okay, if it stays above that blue line, you'll make some money. How much money will I make, Lan? How much will I make? Well, you get to make anything above that white line. What? Yeah, anything above the white line is your profit. So you get to make anything up here. So if it goes up there, you make $1,500. But that means it'd have to go to right there for you to make $1,500. But if we did a vertical spread, I'd only make $300. Well, that means the vertical spread's equal amount would be right here at $300. So if you draw that across there, there's your exact same thing as the vertical spread. So the vertical spread, if you sell the vertical spread, you're going to make the $300. Well, this market would have to go all the way up there to make the $300. Okay. Wait a second. Now the vertical spread's starting to look a little better. You lose less money and you make the same $300. But the thing is what you're giving up. This is the one and one. I'm going to say it again. One in the hand, two in the bush, right? One in the hand, two in the bush. Because the fact is this market could go up here and you could make everything above that white line right there. Everything all the way up to there could be $3,000. Oh, I like two in the bush. Lan, I like two in the bush. Okay, well then just buy yourself a call option right here. Pay $1,000 for it. Okay, market order into that, baby. Now you got yourself a... Oh, how come it's not playing in our sandbox? That was stupid. Lan, why'd you do that? You just paid $55 on a spread because the volume was 0 and the open interest is 76. Aren't you the one that always tells us to make sure that the volume is 100 and the open interest is 1,000? And there you are going and doing a volume 0 and an open interest of 76. You paid $55 to get into that dumb thing. You weren't paying any attention at all. No, that was a dumb move, wasn't it? We didn't check that first thing. Thanks, Kramer. We'll blame Kramer. Should we blame Kramer? Let's go look at Netflix. NFLX. All right, NFLX. Well, they just took NFLX, Netflix, off their list. You can see we're on the back side of the MACD. See what happens when you get on the back side of a MACD? It doesn't explosively grow. Doesn't mean it can't. We got little, counter trends coming in here. But this thing actually did kind of got a little backside of the MACD right there. And then we got a little burst, another little backside of the MACD, another little burst, a little backside of the MACD, another little burst. What do you expect? Probably another little backside in here. And then maybe a little burst. Who knows? Who knows? They didn't like it. They took it off their list. Bank of America, taking it off their list. Maybe they already made all the money they want to make all the way from here up, right? Maybe, maybe not. Who knows? Maybe, maybe not. We don't want to do anything with it, do we? Is there anything we want to do with it? With it? Anything we want to do with it, guys? Let's come in here. Where did Kramer go? Where did Kramer's letter go? There it is. All right. Live monthly meeting. I'm not interested in that one. We hold our live monthly meeting. Gap. Price gap. Price targets raised to 32 from 25 by Wells Fargo. This one has been a rocket ship that I wish we had caught in the trust. The retailer stocks is good, but we have moved much already up 33%. So let's go look at gap. I think we did gap once, didn't we? Gap. What is gap? GPS. Yeah, we got gap. Ha! We got it and Kramer didn't. Ha! Kramer. Ha ha ha. He said, I wish we had that one, but he didn't. We got it. $625. Isn't it funny how banks raise we like this one after it's already run? That's how they do it, right? But we caught it on the breakout. Why? It was actually Kramer said you should go look at Gap. And we put an option on Gap. We bought it. We're up $625. Look, there was another place right there. That thing took off and went to the moon. And then as soon as it did that, it went sideways for a very long time. Are we going to get the same kind of thing? Are we going to get this run and then a sideways for a very long time? And this is going to destroy our profit potential. What do you want to do? What do you want to do? We only have one. We can't like go in and take one off and take some profits because all we got's one. You can roll it, Lan. Ah, that's a good idea. How do we roll it? We come in here and we say roll the option. We roll it up. Where do we want to roll it to? Let's go to 23, 24, 23. How much money do we want to take? 24. So we can take a little bit of profit. So we're going to roll it up. Do we want to go to a 2? No, we don't want to go to 2 days out. There we go. Now we're rolling it up 87. So that's a roll. We sell this one and we buy another one, take some of our profits off. All right. So let's go ahead and we're going to market that out, baby. We just took some profits. We just rolled. It's going to take a minute. There it goes. So we just rolled it up. Take some profits. That's how you do it. That's how you do it. Okay. So we took a little profit. Close out. Let's go see. Chart closed. How much we take? Gain. We took $614 out of that baby, and now we still got another one in there. We paid $540 for it. So position. So it's right there. There we go. That's how you roll it up. All we're really doing is selling one and buying one. That's what roll means. So we sold it out, made a little bit of money, but we still have another one in there, and we can go ahead and let that baby run. All right. Let that baby run. So now we're going to come in here and go over to options. I always lose my Kramer letter. How come that Kramer letter keeps falling? There it is. Okay, the next one. Bernstein. The Bernstein Bears took its Tesla price target to 120 from 150 and kept an underperforming rating, citing soft demand in China and Europe and construction and constrained U.S. Model 3 production. The analysts have hated the electric car maker forever. This just adds insult to injury. Can I get political here for just 1 minute? Elon Musk has sided with Donald Trump to some degree. Now, not completely. He's trying to stay a little bit neutral, but he's leaning towards the Donald Trump camp. He met with him the other day, and we all know that Biden really doesn't like him. I mean, they were talking about electric cars there at the White House, and they brought in all the electric car manufacturers except for Elon Musk, except for Tesla. They did not include them. We've talked about this before. That was kind of a dirty, nasty trick. We know that the Biden administration does not like Tesla. They don't like them. Why? Well, for one, Elon Musk has not said very nice things about the way Biden is running the country. He's not real fond of the way Biden's been doing that. Now, don't shoot the messenger. Don't shoot the messenger. Just telling you the story. All right. So we got Tesla's been struggling, and I think it has a lot to do with politics. I think a lot of look at what Donald Trump had happen to him. I mean, before he became a politician, everybody loved Donald Trump. You know, I mean, he was at every little soiree that they could bring him to because he had a lot of money and he gave money to different political parties, right? The Republicans loved him. The Democrats loved him. Everybody loved Donald Trump. Everybody wanted to go golf on his golf courts. Everybody wanted to go, be a part of Donald Trump's life. Nobody had anything against him. He becomes the president of the United States, and boom, just like that, bam, 50% of the country, 50% of the country, and probably half the world, they won't touch his golf courses now. They won't touch his hotels and motels. And does he have motels? I doubt it. Probably just hotels. They won't touch anything that has anything to do with Donald Trump. Just like that, bam, he lost 50% of his entire world base as clients. Well, I worry a little bit that that's kind of happening to Elon Musk. by siding, by becoming a political figure. And all he wants on Twitter and on his X platform is free speech. Anybody can talk as long as it's not illegal. He's not going to kick anybody off unless you're doing something illegal. So anybody can talk. Well, we know that there's one group that doesn't like that, right? They don't like free speech. And so by having Elon Musk side with the side that wants free speech and be a free speech advocate, and he's kind of leaning over there with old Donald Trump, I think the same thing's happening to Tesla and the same thing's happening to Elon Musk that happened to Donald Trump. I think he's alienating 50% of his base, and they're not going to support or sponsor Tesla because of it. Just my observation. You may see a different observation on that. You may think of that differently, but that's the way I see it. And Tesla's not been doing too well. And I wonder if that's not got a little bit to do with it. That's all I'm saying. It's bouncing right now. It's down here. I mean, technically speaking, we got drive 1, drive 2, and then we had this big, long rebound, counter trend, and we had drive 1, drive 2 once again. Is this going to be a good solid reversal? Are we going to get a nice little head and shoulders in here? Is that what we're seeing here? Possibly, and it might be a good time to load up on some Tesla, because Tesla is a great company. I mean, they've made lots of money in the past, right? This is a nice little head and shoulders pattern down here. I mean, everything's lining up for this to be a rock and roll point, okay? So we're going to come in here. Tesla's a great company. We all love Elon Musk. Well, that's the part that I'm saying. Not all of us love Elon Musk. I love Elon Musk. I think he's great. I really like Elon Musk, right? We started off our day with Elon Musk. Making an extra 10K is easier than trying to save 10K. The sooner you understand that, the sooner your life will improve. Elon Musk is one of our great innovators. We should be proud of Elon Musk, right? And he come here and from Africa. He's a South African. He's an African American, that guy. He's an African American. And so we come in here, and this is all setting up. We got a little break above the yellow right there. Everything looks good for Elon Musk to make more money. But that bank, he's saying, Kramer's saying they downgraded him. 120 from 150. They downgraded him. Downgraded him, and he rallied. They rallied on the day that they downgraded him. What do you think of that? This is that little Wyckoff spring, isn't it? So that's a Wyckoff spring right there. That's a buy signal. The question is it going to go up and do this, or is it going to go up and do this and make a third drive down? Because that would be drive 3, right? Drive 1, drive 2, drive 3. If that's the case, if it goes down and breaks down and doesn't continue higher, if it doesn't break above this high right here, it's got to break above that high. So we're getting higher highs and higher lows. Then we'd have to take this entire thing and move it all the way down, and we'd have to readjust it and do the next leg down, and then we'd have our next move that whole thing down like that, and then that would be the next spring. That would be the next head down there, and we'd have a third drive down. Are you ready to buy right here? You could start buying in here, but anticipate that we could get a third drive down, and you'd have to dollar cost average it down here, or just let it go and get out if it starts to fall. But this is our call to arms down here on the MACD, right? We got a second call to arms right there. Call to arms means that we're going green. It means we anticipate this thing going up and breaking up and the MACD going higher. This time it didn't do it, but that's because it was on drive 1. This is drive 2. Drive 2 is more likely to go up. Drive 3 is even more likely to go up, but it could go up on drive 2, right? So that's what you got going. What do you want to do? What do we want to do in our portfolio, in our class portfolio? We can come in here. Let's go out. How long do we think we need? Let's do a little Fibonacci projection off of this thing. The only way we can really do this, we can do this, and anticipate maybe up into 100% up in here. May 15th, how many days is that? We're going to go from where we're currently trading out to the 100% level. We would need 50 days, so we want 100 days. So we come into our options table. Let's say 100 days, 115 days. $2,295 option. Buy our call. We're just going to buy a call right here. Just buy it, right? One click in the money. At the money, 28. One click in, 25. Why one click in? Well, it gives you a little higher delta. Goes from 60 to 63. It's not that much. And the premium increase is $200. We'll just go right there. Okay, let's go ahead and we're just going to buy an option here for old Leon Musk. Leon Musk? Who's Leon Musk? How about that? Does that sound good, guys? Just buy us a little call option. We'll just go in gentle right now. We don't want to go into with 10 of them because this is the second drive down. We may have to dollar cost average and go down the next one. So that is on that burst of that one bar, but got to keep in mind that they're saying they don't like it. They're going to take it down to 120 from 150. So we're going long. We're going against the Bernstein Bears. All right. Former President Donald Trump's newly merged social media company, Trump Media Group, will begin trading Tuesday on the NASDAQ market under DJT. What is today? Today's Tuesday. DJT. Donald J. Trump. Trump Media. There he goes. Now, if you want to help Trump, if you like Trump, if you're a Trump supporter and you like Trump and you don't want to give him money because he's got lots of money, right? But that Letitia James, she just nailed him for like $500,000. So he got it knocked down a little bit, down to like 125 million or something, right? So now the way he's going to get that money is he's going to come in here and he's going to sell his Trump Media, or he's going public. So if you want to make some money off of Trump and also support Trump, you could come in here and buy some Trump Media. Are we going to have any options on it? Nah, no options. Let's come in here and day trade it. 1 minute chart. They're talking about this and just being basically a meme chart, meme market. People want to help Donald Trump. You come in here and buy his stock. That's how you can maybe make a little pumping up his stock and making it go higher. And he'll make a little bit more money, and then he'll be able to pay off Letitia James and the New York prosecutor. I know some of you think that that's a dirty trick that they're doing to him. So this would be a way you could support him. Buy some of his stock. Is it going to keep going? Took off like a rocket ship first thing out of the gate. We're going to keep an eye on that one. All right, we're going to keep an eye on that one. Trump Media, Class A stock. All right. What's the next thing that we're looking at? Cocoa. Cocoa prices hits $10,000 per metric ton. Oh, that's cocoa. Hershey, that's cocoa. Cocoa. This will hurt Hershey and Mondello. And that's probably why we had Hershey, didn't we? And we had to liquidate it. Can't remember Hershey symbol. HSY. Yeah. Oh, we didn't liquidate it. We sold a call against it. We're down $387. Cocoa hit $10,000. Cocoa hit $10,000. This was a seasonal trade. Seasonally speaking, markets have a tendency to rally during this time frame. And obviously, that's not working out too well for us. We're going to collect 200. How much have we collected on that 200? Go to our positions. We've collected 85 out of our 200, but we're losing big time. $910 is the max we can lose on our buy call. We're down 470, 85, making it 385. I hate to do it, but your first loss is your best loss. First loss is your best loss, boss. Liquidate. Let's kill both those at the same time. Come on, let me out of them. It's going to think about it. It doesn't want to let me out of them. Cancel. Edit. Clear. Edit. Delete. Let's see if we can get out of them one at a time. We got to get out of the sold one first, because otherwise your margin would go through the roof. Okay, took that one off. Now we'll take this one off. Let me out. You dirty bugger. They don't want to let me out of that. What's the volume on it? That's why. There's nobody trading it today. 22 open interest. Nobody wants these things. Liquidate. Give me more money. Give me more money. Give me more money. Oh, they want more money. They want to go all the way down to 20. Ooh. I had to pay $30 to get out of that thing. First loss is your best loss. Know when to walk away and know when to run. All right, cocoa. Former WeWork CEO. You know, we could go over and look at cocoa in the futures market. The prices are hitting $10,000 per metric ton. It's going through the roof. Go look at cocoa. I wonder if they got a, sometimes you can find COCOA. Cocoa. Nope, there's no cocoa ETF. Sometimes you can find things over here, like corn. You can find a corn ETF. Look at that. You want to trade corn on the futures market? You can trade over here in the stock market too. There's corn. Pretty cool. ETF on corn. Not that that's what you'd really want to do. If you're going to trade corn, you probably want to do it in the futures market, but not that you can't. You can buy corn for the long haul. All right. What's the next thing? Man, we're running out of time here. Morgan Stanley says Seagate, Micron. We've looked at Micron, Walgreen Boots. Let's look at one more and we'll let you go. Let's go look at Micron. All right. MU. Micron. Look at that baby go to the moon. We were day trading this one the other day, weren't we? Made some money day trading it. Oh, that's kind of ugly today. Went to the moon, but then dropped back hard. What do you want to do on that one? I don't want to do anything. That thing's already reached its extension. Way early, too. Came in 161.8, almost 161.8 on that projection. It hit that 130.9 and blew right through it. All the way up almost to 161.9 on that Fibonacci. Well, you're not there, land. Put it in the right spot. Okay, it's not that far off. Close right now at 130.9. 130.9 is your Fibonacci golden ratio on the extension. And that's where that closes. It's sitting right there right now. Right there right now. Doesn't mean it can't go higher tomorrow. It certainly can. But it's not doing anything right now. Got plenty of options if you want to buy an option. Boy, I just don't know what to do. 1, 2, 3, 4. I would expect a little bit of a pullback. Give us a couple red bars in here, MU, and then we'll see it go again. Micron. They make chips, computer chips. High demand for computer chips nowadays. All right, guys. I think I'm going to let you go for the day. And I think we've gone way over time. And if you liked today, if you thought we had a lot of fun, let's go ahead and like and subscribe. For those of you guys who haven't subscribed, we get a lot of people come and watch our videos and they don't subscribe. Watch and subscribe. Hit that subscribe button so you get notified when we do these live sessions. You can come and join us. We'd like to have you here live. Got a good little group watching. So right now, if you haven't subscribed, and if you guys like this, give me a thumbs up. I think we had a fun day today. We did well. Didn't do so well on the day trading side of things, but we made some money in our options over here. We liquidated out. What did we do? Come down here. Look at the positions. Let's see. Closed out all. We closed out $204. We had to take off a loser, 490, but we made 614 and 80. So overall up $204 on the day. Not bad. Clearing out a loser and taking some profits on our winner. So made up for the loss we had over in the day trading. That's how it works sometimes. Sometimes you lose over there and you make it over here. Sometimes you lose over here and you make it over there. Sometimes you win in both places. Sometimes you lose in both places. That's just the nature of the beast, right? All right, guys. That hopefully was a good class, good lesson for my class, my students. And we will pull up just for the last minute here, go over and look at the futures market and see where it's at with our day trading stuff and with our S&P option. Look at our S&P. Let's go see what that thing's doing right now. Position on the chart only. We're up $30. There you go. We're up $30 and our goal's 100. It'll take it off at 100. We could take that off and let it go to 200. Or did we say 200? Just going to take it off at 200. All right. So, or we could just let it go all the way to expiration and take the full, what was it, 600, right? Whatever you want to do. It's up to you. You're the trader. Do it the way you want. I'm just showing you what I want to do. I'm just showing you ways to do different things. You have to choose which one you want to do, what you want to do. All right. Don't forget to go subscribe to Pit News Magazine, guys. Pit News Magazine. Pit News Magazine. Everybody needs to subscribe to Pit News Magazine. You get the first 3 months for $1, and it's an amazing thing. We got a really cool article coming out for you in Pit News Magazine this time. I'm real excited for you to have. I actually had a nice interview with Tom once again. I'm not sure if that's going to make it in the issue, though, because it came in late. We didn't quite get that done in time. But it'll be in the next one for sure. Maybe this one. We'll see if we can't get it in there. But that interview with Tom, who's telling us a little bit of insight from hedge fund manager's portfolio point of view. You can listen to the articles. You can read the articles. You can watch some videos. It's a great little tool, something we use to keep in touch with each other. If you don't have Pit News Magazine, go get it. $1 for 3 months. If you don't like it at the end of 3 months, cancel. You don't have to pay the $50 for any more. But I can promise you, you're going to fall in love with Pit News Magazine. Everybody should have a copy. All right. Anything else? That's it. See you guys. Same bat channel, same bat time tomorrow.